Welcome to This Is Money podcast, sponsored by Charles Stanley Direct. I'm Georgie Frost, and joining me and Simon Lambert today is Helen Crane. And coming up, Nationwide confirms it will hand out its £100 fairer share payment for the third year running. Do you qualify for June's payout? Are you rich enough to get a free £500 Selfridges shopping trip or £100 of monthly perks? The big bank drive to sign up wealthy customers steps up. Simon explores what £10,000 worth of Nvidia shares bought at different points is worth now. Spoiler, it's likely to be a lot. Trouble ahead as 500,000 households fall off their ultra-cheap 5-year fixes. And is my wife putting off buyers? Asks one reader. Definitely trouble ahead with that one. Don't forget, you can stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Take control of your finances with Charles Stanley Direct. Invest, save, coach, or plan. Using technology where it's helpful and people where it matters. Our website and app make trading cost-effective and flexible. But we're more than just an online investment service. We're here for you regardless of your financial needs or if your life takes an unexpected turn. Your finances, your way. Take control today with Charles Stanley Direct. Sign up now.
Investment involves risk.
But first, could you get a cool £100 drop into your bank account? Nationwide this week announced it will pay out another fairer share bonus this summer to its 4 million eligible members, a collective total of £400 million. Now, this marks the third annual fairer share payment Nationwide has offered to its members and comes after what the chief executive, Debbie Crosbie, called an outstanding 12 months for the mutual giant. Last year was a disappointment, though, for many who didn't receive it. So who is eligible? Simon, Helen, welcome. Helen, firstly, what is fairer share and how can Nationwide pay it?
So fairer share is this £100 payment which Nationwide has been handing out to certain members for the last, this is the third time I've done it, so it started in 2023. It's based on the idea that Nationwide is a building society, so obviously doesn't have any shareholders, so it wants to share its profits with its members. So the idea is that every year Nationwide does well financially. They bung some of their customers £100 bonus. But the controversy with it is not every Nationwide member is eligible. So in essence, you have to have a current account with Nationwide and then one other product, so a savings account or a mortgage. People who get the payment absolutely love it. People who don't get it can be quite irked.
Miffed, I think, was how it was last year. Because there's something like, is it 17 million people that have some sort of account or mortgage with Nationwide, and only about 4 million people get it. However, Simon, 12 million, I believe, got 50 quid, including yours truly here, in March. This is not related. Tell me about Nationwide's outstanding 12 months.
Nationwide has been making an absolute packet. It is the country's biggest building society, arguably the size of many of our major banks, certainly in terms of its retail operation. It posted bumper pre-tax profits of £2.3 billion in the year to April. That's up from £1.77 billion last year. So that's a lot more. And that's after recording its highest ever year for growth in mortgage lending and current account balances. So Nationwide is doing a lot of mortgage business. Banks and building societies are able to make more money on mortgages now than they were when rates were lower because you can have a better margin between savings rates and mortgages. And actually, the savings market has been very competitive, certainly over recent months for cash ISAs, with the competition that's come in from some of the investing platforms and things like that. But you can still make that net interest margin, which is the difference between what you're paying savers and what you're getting in on your loans. And it's not just mortgages as well. You have to bear in mind that also personal loans come into play here and credit card rates. So Nationwide's been doing very well. Now, as a giant building society that you would think couldn't get much bigger, but does continue to get bigger. In fact, some of those profits came from buying Virgin Money earlier this year. Nationwide has a bit of an issue. The idea of building society is that it's owned by its members. It's owned by the customers. So I'm a Nationwide member. I own Nationwide. Helen's a Nationwide member. She owns Nationwide too. Are you a Nationwide member, Georgie?
I think so, yeah. Well, I've got a mortgage there. Does that count?
Congratulations. You own
Thank you.
Nationwide.
Awesome.
Teeny tiny little bit.
Yeah.
I'm sorry,
Widdly.
but you're not getting much of that 2.3 billion. So the idea is that what a building society does is it rewards its members with higher savings rates and lower mortgage rates. So it rewards them with better rates on the products they take. And the two main products, the two traditional building society products, are mortgages, clues in the name, building society, and savings. You're taking people's savings, you offer them mortgages. Nationwide's unusual in offering current accounts as well. There aren't actually that many building societies that offer current accounts. The issue it's got, as I said, is because it's so big, and also it's got that pull of the big brand name, that if it were to recycle these profits into simply offering savings rates that beat all its competitors, then it would find an influx of money into its savings accounts that would be unmanageable, and it wouldn't be able to pay all those people, and it could potentially completely distort the market. I mean, maybe Nationwide should be driving up rates across the market, but there is a problem there with doing this. Then mortgage rates, same thing. If it were to offer rock bottom mortgage rates, it would have an issue where it would have a flood of mortgage customers that was unmanageable. Now, what you can do is you can try and bring the rates down for your existing customers in terms of mortgages, or bump them up for your existing customers in terms of savings. And Nationwide does a bit of this, the kind of loyalty saver, loyalty mortgage stuff. It ebbs and flows. At times, there have been some fantastic deals. I once had a fantastic Nationwide tracker mortgage that, even though I was moving home, came with free conveyancing, free survey, all free stuff, and was fee-free and was on a really good rate. And it was absolutely fantastic. I saved probably, I don't know, well over £1,000 in home moving fees off the back of that one. So that was a really good deal. At other times, the member exclusives, just, you could probably just get a better deal elsewhere. But this is where Fairer Share comes in. And it's a stroke of genius in my mind. Basically, you just give some money back to the customers in a lump sum, which feels like a windfall. £100 is £100. You can go out for dinner with £100. You can treat yourself with £100. It's a good amount of money to land in your current account. So they give that money back to people, and people are very happy if they get the money. Now, obviously, Nationwide has to draw the line somewhere. Otherwise, it would just get a flood of people opening just one thing and never using it in order to pick up their £100. And that wouldn't be very fair on everyone else. But where it has decided to draw the line is that you must have a current account, an active current account. So it needs money going in and out of it. So you must either have a current account and a savings account, or a current account and a mortgage. Lots of people got caught out by this the first time Nationwide did Fairer Share.
Oh, I'm not a member then.
Right, so you don't have a current account.
No, I just got the 50 quid, that's it.
Yeah, so you got £50. Okay, Nationwide gave £50 to loads more people because of the Virgin Money takeover. Now with this, though, it's saying you have to have a current account. It caught a lot of people out first time round, but this is the third time they've done it, and they've done it on the same criteria each time. And so if you were annoyed at missing out first time round, you had the opportunity not to miss out second time round. And third time round, really, it starts to become okay, well, they are going to do this. And there's been no secret, really, they're going to do this. There's been some heavy hints about this. And we've actually written loads of stories and talked about it on this podcast in March and said, if you are a Nationwide customer and you want to get your Fairer Share payment, you need to do X, right? So you need to basically just put some money in a savings account, right? And just have it £100 sitting in a savings account and use your current account. And that's all you need to do. Now, I know that there are two people on this podcast that nearly missed out on their Fairer Share payments, despite editing and publishing lots of stories telling people to do this stuff. Two of us went, oh my God, we haven't done it. We're going to miss out on our Fairer Share. And I'm sorry, Georgie, but it sounds like the third person has missed out on their Fairer Share.
Yeah, I know. But, Helen, Nationwide is splashing the cash, offering a £200 switching bonus for members, though. Does that mean I wouldn't qualify for that? Because I don't have a current account, but also they're offering an 18-month fixed rate savings account paying 5% interest. So, who is eligible if you want to get this 200? Is it just you two? Could I not do it? And then what's the point in that if you've already got a current account there?
Well, I think you can do it because I think you are a member. You're not a member that could get the £100 payment, but you're still a member is just anyone who has a product with Nationwide, as I understand it. So I think you could absolutely get the £200 if you switch your current account, and then you'd also get the £100 bonus as well.
Would I get it next year though? Don't you have to have been a member by March something or others?
Yeah.
I think I might be a bit late to get this year, but next year I could, right?
Yeah, unfortunately, I think you are done for this year, Georgie. Sadly, but next year, if they do it again, they haven't said they'll definitely do it again, but it seems very likely as long as they continue to do well, as Simon said. So yeah, the chance isn't over, Georgie.
Oh, well, there you go. So, well, I could get £200 from switching, but also this 18-month fixed rate savings account paying 5% interest. That sounds decent.
Yeah, this is an interesting one. So they've launched this savings account. It's exclusively for their members. It's 5% interest. It's called the Member Exclusive Bond, and it's an 18-month fix. So you do have to be willing to put your money away for a year and a half. The maximum amount you can put in is £10,000, but that's obviously fairly chunky amount. Yeah, if you are a member and you do have that money to put away, then it seems like a fairly good deal. It's the best buy on the market for that length of fix. So yeah, it seems like a bit of a no-brainer, really, if you're in that position.
And in terms of what else is out there, let's start with the switching bonuses. I think Santander released one this week, was it, for 180 quid? Do you have to be an existing customer for that one?
The Santander one, no. I think you have to be switching your current account from another bank, and you have to then close your other current account. So yeah, you have to be fully sort of signed up to Santander. I think there's bonuses out from First Direct and Co-op Bank as well.
Yeah, 175, I think, for First Direct. TSB, there might be 100. But the point is, it goes in fits and starts, doesn't it, these switching bonuses? Sometimes you get a load of them, sometimes you get nothing. What does this indicate, I guess, Simon, about the market at the moment? Are banks flush with cash and desperate for our money? I mean, what's going on?
What it indicates is why having current account customers is still important for banks. You would think that perhaps in this day and age, it didn't really matter that much. When it comes to mortgages, when it comes to savings, when it comes to credit cards, people just go on the internet and look for stuff. But actually, most people still get tempted into just opening a product with their bank. And if you are a current account customer, that is the linchpin of pulling you in to take out other products that make your bank more money. Now, at the moment, if you're one of those people who leaves money sitting in your current account, for example, of which there are many, and the wealthier you are, maybe the more likely you are to do it. Although I would like to think there comes a cutoff point where people have so much money that they've got the sense not to leave large amounts of cash sitting in their current account. But there will still be plenty of people who do. The more you leave sitting in your current account that pays you a negligible rate of interest, or perhaps no interest at all, the more money the bank can make off you, because it's got that money sitting there and it's not having to pay you any interest on it. But it can also cross-sell you a product. Perhaps you might like a credit card. Well, a credit card would come with a 30% APR on it. Ooh, nice little earner. Now, if you pay it off in full every month, that doesn't matter because you're not going to end up paying any interest. But people always slip up. They don't make the payment. They don't pay off the full amount. Maybe they forget. Maybe they just don't have the money that month, or they decide to spread it over a period of time. And then, oops, there you go. Bank's made a load of money off you. Or you might take out a mortgage. And at the end of the day, it's just going to be easier to speak to your own bank, isn't it? I mean, don't do this, by the way. Basically, what you need to do is you need to compare all the mortgages on the market. And the easy way to do that is go to thisismoney.co.uk/mortgage-finder, where you will find our chosen partner, L&C. Why have we chosen L&C? Because we've worked with them for absolutely donkey's years, and they're fee-free. You don't pay them any money. They make their money in commission from the lender if you take out a mortgage, and they will compare mortgages across the whole of the market and help you decide how long to fix for. And it means that you're not just at the mercy of whatever your bank's going to offer you. So all this illustrates that banks, it pays off for them to have you as a customer, even if they're going to give you a £500 Selfridges voucher and the option to have a VIP shopping experience instead and load you up with freebies every month. Because you also have to remember how much are those freebies actually worth to you. Your bank might put a number on it. It might say, well, this is worth this, and that is worth that, that is worth that. Firstly, are you going to use all of them? Mobile phone insurance, useful. Travel insurance, useful. Is it up to scratch? Are you going to need to have separate mobile phone insurance anyway, or separate travel insurance? And are you just insured for this stuff in the first place? Maybe you already have a travel insurance policy. Maybe your mobile phone is covered under your household insurance policy. It's things like that. And also then you've got things like offers of, free cinema tickets or money off at various places and cards that get you money off your food and a free coffee every month and all that kind of stuff. Now, this is great. And if you're the kind of person who maxes this stuff out, then you are going to be picking up absolute maximum value. But bear in mind, the bank has got some really clever number cruncher sitting somewhere working out the percentage of people likely to use this stuff, the percentage of people likely to use it and actually fully take advantage of it, the cost of that, and therefore what it can afford to offer that still makes the account profitable for the bank. And you might be paying for some of these accounts as well. You need to factor that in mind.
Well, Helen, Simon's teed us up beautifully for half the stories we're going to talk about later. So, Simon, think about that and remember that advice, particularly with mortgages, because we're going to come back there shortly. But, Helen, let's stick with the perks, because there's a story on your website, a couple of stories, actually. Because if you're rich, big banks want you, or they want your money, but they want you, and they are willing to pay for it. So HSBC has launched a switching deal for its exclusive Premier Bank account where customers can get £500 Selfridges voucher and a VIP shopping experience. Don't know what that involves, but you'll tell me. While Lloyds has launched a new Premier account with £100 of monthly perks. But the question is, well, there's two. Are you wealthy enough? And two, are they actually any good, Helen? So what's going on here? Let's talk about the HSBC and the Lloyds Premier Bank offers.
The HSBC Premier account, I just think this is quite amusing, to be honest. So to get in rich people, they are offering a £500 Selfridges voucher and the option to have a VIP shopping experience. So, we quite often see banks bunging cash at people to take these accounts. But I feel like they're taking it to the next level of bougie by saying, we're not just going to give you cash, we're going to give you VIP Selfridges cash.
What's the shopping experience? I'm really intrigued. What does that mean? Am I going to get a personal shopper? Are they going to pay for anything? Or is it just like I get champagne or something? I'm expecting big stuff here.
Well, Georgie, the VIP experience includes access to the Selfridges lounge and a complimentary drink, as well as the £500 voucher. I mean,
well, I should hope so.
It just sounds like you go in a lounge and you get a free glass of Prosecco. I mean, but it could still be good. Could still be good. You don't know.
I mean, it's free. So, well, it's not free because you have to have a lot of money, don't you, to get this account? How much do you have to be? How rich do you have to be?
So you have to pay a salary of £100,000 into the account, and that does have to be a salary. So you have to earn £100,000 a year or more. That's doable for some people. However, I think, as Simon was saying, you have to really think about these perks and whether they're actually worth it for you. It is worth saying, though, that this HSBC Premier account, it doesn't have a monthly fee.
Okay.
So that's one of the sort of better things about it. You're not going to be paying every month to get this account.
But what's the point of it? Take the switching bonus away. What's the benefit if you are £100,000 plus earner of going with one of these Premier Bank accounts, whether it's HSBC or whether it's Lloyds, particularly one where you have to pay for it? What am I getting in return?
So the list of perks on this HSBC one, quite an unusual one, actually. Customers will be able to access online health services through a new HSBC Health app, including digital GP appointments, remote physiotherapy. I have no idea how remote physiotherapy would work.
I've heard this.
And mental health support. So, yeah, quite an unusual one.
Okay, so you've got a health service. That's interesting, I suppose, for lots of people.
Yeah, and you also get the more sort of standard things, so free worldwide family travel insurance with cover for your children up to the age of 23 and preferential rates on foreign currency exchange and international payments. You can also get wealth management advice and preferential rates on savings and mortgages. And I think that's the interesting thing. So the idea behind a lot of these banks offering these sort of bungs to wealthier customers is that they want to upsell them to services like wealth management and investments. That's really what's behind it for them. So I think saying, oh, you can get free wealth management advice. Well, yeah, because that's going to get you to spend a whole lot more money with them. So I think that's really what's behind this.
It's great being rich, isn't it? Like on so many levels in finance, you get the best rates, you get the best deals so that you can be richer for longer and more rich.
Yes, of course, it's great to be rich. But I do feel for these poor HSBC Premier customers because whilst they get their bougie shopping experience, they also get stung at the other end with a 60% tax rate and maybe losing their free childcare. So they've got a gazillion% tax rate. You've got to get something back, haven't you? And if it's a £500 Selfridges voucher or the chance to go shopping there, again, things you can just do anyway. You can just go shopping Selfridges. Just to be clear, people, Selfridges does not yet have a door policy that stops people going in there. You can just shop in Selfridges. However, HSBC says the offering echoes the demands of affluent customers for services that support and enhance their lifestyles. Who wouldn't want that? Look, I'm a strictly bog standard current account kind of person. I like a decent current account, but I don't need any bells and whistles on it. So I have current accounts with numerous organisations. I'm very happy with First Direct's customer service for many years. But actually, Starling, I'm quite a big fan of due to the way I think the app
And they don't offer you anything.
works really well. They don't offer you anything. No, they offer you something that is genuinely worth something to me, which at the time First Direct did not offer me, the chance to spend overseas without any fees.
Oh, yeah, sorry, I take that back because that's really good for me. I've got it.
And that is unlimited. Right, so it's not like, I don't know what Monzo does now, but Monzo, everybody banged on about Monzo for this, but Monzo was limited quite heavily, whereas Starling's is unlimited. And actually, if you look at that over the course of a couple of holidays a year, or more, if you take more holidays a year, then it can save you quite a bit of money. That's actually the reason why I opened a Nationwide current account in the first place, was because it used to offer the fee-free spending. And then it stopped doing that. And that was a big deal when it stopped doing that, because it was really the only one offering fee-free spending on a current account abroad. And so I switched and opened an account with First Direct just because I thought I'd try it out, but still kept my Nationwide account. And then I've been very happy with First Direct's customer service. First Direct now does also offer fee-free spending abroad. But another banking organisation I have been a loyal customer to for many years, I'm going to go off piste here, right? I am now no longer a loyal customer to. And this illustrates how some of this sneaky new customer stuff does not pay off. Barclaycard. Now, I've not been a loyal customer to Barclaycard out of any love for Barclaycard, okay? Barclaycard, in my general experience, are a bunch of clowns. Right, and don't deserve people to be customers there for over 20 years.
Why? Backtrack, Simon.
Oh, they just keep doing stuff that annoys their customers. They just do it all the time. But do you remember when they just randomly cut people's credit limits?
Yeah.
A few years back, it was during COVID, and they said, "Oh, well, your financial circumstances have changed." I remember speaking to them saying, "My financial circumstances haven't changed at all. I'm in a fortunate position where they've literally they've not changed, and they cut my credit limit down to like an unusable level." And I was like, "Well, can you put it back up?" And they're like, "No, you missed the opportunity to do that. You can apply to have it put back up again." And this was after them ratcheting up the credit limit loads. Or when you used to get those letters saying, "We're going to stick your credit limit up £1,000. Not, "Do you want us to?" It's like, "We're going to do it. And if you don't want us to, contact us." And then they started doing that again, like just ratcheting it up without me even asking. I'm like, what are you doing? But the thing that really annoyed me is I had this permanent low rate credit card. And then they'd edged the rate up on that. And the great thing about this was that basically you could spend on it and then you could spread the payments if you wanted to, because rather than paying 20 to 30% interest, you were paying like 6% interest, which is still interest, but it's a lot more manageable if you basically pay something off over a few months. They edged that up and then they just whacked it all the way up. Just went, no, it's just a normal card now. It's 30% interest rate. So anyway, I decided I wanted a low rate purchase card, and I went looking for the best ones on the market. And lo and behold, Barclaycard offered one of the best ones on the market. So I tried to open it, and I couldn't open it because I'm an existing customer. So I joined the chat. I got involved. I had a chat with someone from Barclaycard in the online chat, and they said, no, because you're an existing customer. I said, well, that's not very fair, is it? They said, well, you're an existing customer, you can't have one. And then basically there's this big, long string of messages of me going, well, I really don't think that's a very fair way to treat a customer of 20 odd years. And them going, you can't have it. Basically, they were the variations on a theme of you can't have it. And I did actually screen grab this because I meant to use it for a column at some point and I haven't. So I'm just going to share it with you, podcast listeners. So anyway, I was like, right, that's it. I'm ditching Barclaycard. So I didn't do anything for 3 months. And then I was like, right, that's it. I am ditching Barclaycard. And I've now gone off and found a better card somewhere else with another provider that will offer me a 0% purchase card for, however many months it is. And I was like, right, I'm closing that Barclaycard.
Yes.
And I was like, no, don't do that. Leave it open, but just don't use it because that's more likely to be annoying for them and cost them money.
Is that good for your credit rating though?
Probably not, but it doesn't matter that much.
Not buying a house anytime.
I mean, your credit rating does matter, okay? Just don't like when I said it doesn't matter that much. Okay? Exactly. Yeah. When I said this, I had a day off yesterday. I took my daughter and my niece to go surfing at the Wave. And I was listening to the radio in the car on the way down there, and we had the Radio 1 breakfast show on, and Greg James was on. And at one point, he accidentally told people to go walk up Snowdon in flip-flops, and then went, no, actually, don't do that. Do not walk up Snowdon unprepared. So just to be clear, like my don't walk up Snowdon in flip-flops moment, right? Your credit rating does matter, okay? Don't be blasé about it. But in this instance, I don't think it's an issue for me
you,
personally.
Yeah, fair.
So I'm going to leave it open because I think it's going to annoy them more, and I've probably just opened the doors for myself being defrauded here as well. So I'll tell you about that in the future.
That's fine. Never mind. I hadn't thought about this, but I have a similar sort of story about Barclaycard. So I got my credit card, as many people do, at university, and I got a free football. Obviously, that's why you should definitely get a credit card for the free football. Don't, by the way. And fast forward, I had obviously major back injury and I couldn't work for about a year and I got quite into credit card debt. And I had forgotten about this story until yesterday. And I remember sitting in a car outside my auntie's house in Manchester. The details are just for effect. You don't need to know where I was. And I remember being on the phone and I didn't know about money then. I was a sports journalist, etc. And I had just paid it off and it was thousands. And I wasn't earning that much. And I remember me saying, I want to cancel this card. I want to cancel this card. And then they were like, are you sure? Are you sure? It felt quite a lot of pressure. Are you sure? Because you might need it in the future and it's really useful, etc. And as someone who was sort of quite ignorant, I was like, oh, okay, then I'll keep it. And guess what? I got myself into loads and loads of debt on it as well and took, again, years to pay that off. I hope that's changed. But that poor little me sat in my rubbish car in Manchester getting that phone call and being quite heavily strong-armed. And that's why it sort of leaves me with a bit of a sour taste in my mouth. Sorry about that trip down memory lane there.
No, I think, these things, people need to watch out for these things. And I would say this to especially those listeners of the podcast who are younger. And I think certainly if you're a student, and you get caught out by these things, or you've just started work and you get caught out by these things, because they do tend to target the kind of younger audience with some of this stuff. And you'd like to think that, people wouldn't fall for it, but even people who are, very financially experienced with many years of like banking and mortgages and credit cards and things under their belt fall for this stuff. And that's why they do it, because it works. I mean, I remember a friend of mine, we were at a Watford game and this girl came up to us and she said, would you like a free hat? We were like, what? Would you like a free hat? She was like, some Watford hats. We were like, yeah, all right, we'll have a hat. She's like, oh, you just need to fill in this form. We were like, what's this form? It was an NBA credit card application. We were like, yeah, I don't really want to do that, credit card. She's like, no, it's fine. You could just like fill in the form and get the hat. You don't have to, it doesn't matter.
Wow.
Me and my friend who also works in finance were like, pretty sure that's not how it works. Anyway, he filled in the form with fake details, but sort of, I think he did that thing where he put his name down and then faked some other details and things like that. And it was a jumble of, various things rather than just totally fake details, which is what he should have done.
Yeah.
If you think about it, because they weren't checking IDs against the free hats. And he didn't think anything of it, and it just became a joke, for many years, the free hat. But anyway, a couple of years later, he then got something from MBNA about his credit card, and he was like, what? And they'd managed to jigsaw identify him and issue him with a credit card application.
Wow.
Was it a nice hat, though?
The hat was rubbish.
Anyway, Helen, you've waited so patiently there. Apologies for Simon and I going off on one here, because there are sort of two bookends to these stories I would like you to cover. One is the Lloyds offer, which sort of seems to have been lost in the ether, but that they're also wanting to get rich customers. But also we talked about nationwide savings accounts. I just want to know kind of what else is out there at the moment. But let's go very briefly. The Lloyds offer of £100 of monthly perks. Sounds good, doesn't it?
Yes, this is also for people who have income, savings or investments of at least £100,000. So unlike the HSBC one, you don't need £100,000 salary. It could be made up of other money. You can also get the account if you're able to pay in £5,000 a month. It does cost £15 a month. However, that's refunded each month if you meet the eligibility criteria. So if you pay in those amounts, you pay the fee, but then you get paid it back, which sounds slightly confusing, but it seems like if you meet those, then you don't have to pay the fee. The perks on this one, so it's the same as the Club Lloyds account, which is the quite popular current account. However, it has an extra layer, says Lloyds. So you get free spending abroad on your debit card, 6 free cinema tickets, or 12 months of Disney Plus. You also get GP and well-being services, lifestyle benefits, I don't know what that means, travel perks, cashback, discounted mortgage rates, which could actually be quite useful, and appointments with financial coaches. I feel like these financial coaching and sort of wealth management advice thing, I think that's the kind of thing that a bank will tend to sort of let you do for free anyway if you've got quite a lot of money to invest. Oh, you also get a Bupa Family GP subscription service, which provides access to online GP and nurse consultations, online physiotherapy sessions, and online mental health treatment. So this sounds similar to the HSBC offer. Again, you can get healthcare for free, but I would suppose that this is targeted at maybe people who use private healthcare, or perhaps people from abroad. I don't know, I'd have to look into the rules on that one. Also comes with 1% cashback on debit card spending, quite good. Oh, but it is capped at £10 each month. So, if you are going to use those things, then fair enough. But as Simon said, if you aren't going to, then there's absolutely no point in signing up to the account. If you already have Disney Plus, you're happy using the NHS, you don't need online physiotherapy, then maybe it's not for you. But it's just about thinking about what you need and what you'll use. And if you do sign up to the account, really make sure you use the perks. That's what I always get with these things. I'm quite a lazy person, and even if I know I have these things, I just won't ever be bothered to use them. This is why I switched my mobile phone from O2, because they had all these things like, oh, you can get like a free hot chocolate every week at Costa, and I would just never ever do it. It's like, oh, if you go to an O2 venue, you can use a cloakroom for free, and I would just never ever do it. So then I just switched my mobile phone to a much cheaper network, and still don't get free hot chocolate or free cloakroom.
Yeah, so that's something I've never struggled with. I'm at a hotel at the moment in Vienna, and I paid £20 for a breakfast just because I was in a rush to obviously come to this podcast. And I wasn't really that hungry, but damn it, I made sure that I ate £20 worth, and even was totting up in my head. That's how sad I was. But I felt that was quite excessive for breakfast, £20. But anyway, savings account, just a quick one. The nationwide offer for its members, Helen, that we spoke about, that paying 5% interest, 18-month fixed rate savings. What else is out there?
Yeah, so that nationwide account is the best account if you're looking for an 18-month fix. It does have that maximum of £10,000 on it, though, which means that you would receive £762.50 in interest after 18 months. If you did have more to save than that, the next best deal is with Oxbury Bank. That pays 4.45%. And if you don't want to fix for 18 months, you can fix for 1 year at 4.44% with Castle Trust Bank. So do have a look at This Is Money's best savings rate tables. We've got a list of all the accounts and how much they pay on there.
That's it for part one.
I'm joined now by Rob Morgan of Charles Stanley Direct for our weekly Investing Explained feature. Rob, we've got a question here. How much have stock markets rebounded by since Donald Trump's tariff pause?
Yes, there's been a dramatic about turn in market sentiment as the risk of a very damaging tit-for-tat trade war has faded for the time being, and investors have taken an increasingly glass half full view of the tariff saga. So to recap, the US markets fell about 10% in the aftermath of the tariff announcements on Liberation Day. So that was the 2nd of April, and that took the US S&P 500 index to about 15% lower than it was at the start of the year, with the technology-heavy NASDAQ index down a shade over 20%. But if you'd not really bothered to check the markets or your own investments this year until now, you'd perhaps not notice too much change, because having staged a 19% rally from the low point on the 8th of April, which is when Trump softened his tariff stance, the S&P 500 is now marginally up year to date, and the NASDAQ is down just 3%. It rallied a huge 23% from the low. And that was fueled not only by the risk of very damaging tariffs fading, but some good earnings results settling investor nerves. So we're actually, broadly speaking, back to where we all started pre-Liberation Day, before that tariff shock, and US markets are not that far off all-time highs. And this pattern is repeated in other markets too. For instance, the FTSE 100 here in the UK is up 14% since the post-Liberation Day low, and the index stands not far off its high point earlier this year. However, this all doesn't quite tell the full story for UK investors, because at the same time, amid the trade concerns, the US dollar has lost about 10% of its value against major currencies, which is why the US has still been one of the weaker areas for UK investors this year, and why recent investments in US assets are still probably showing mostly losses in sterling terms. So over the longer term, those sorts of currency movements don't tend to take on much importance for stock market investments, relatively speaking, but as this episode shows, they can do in the short term, and that poses an added risk.
Rob, thank you very much.
Welcome back. Forget the lottery. If you want to win big, just pick the right shares. Granted, it's not an easy thing to do, but for those who had bet on Nvidia in the early days, they would be massively quids in. Simon has taken a look at the AI chipmaker's journey and the returns for investors over time. Simon, why?
Right, Nvidia. I mean, what a stratospheric share price rise that company has had. If you were lucky enough to have bought in the early days, then you would be sitting on a tidy sum of money, in theory. And we crunched the numbers on if you'd bought at various points in time, which led to some reader comments from people saying, yeah, and if my aunt was my uncle, and so on. It's like, yeah, great, all you need is a DeLorean. Like, fair point. Obviously, you don't have a time machine. You can't go back in time to 1999 and buy some Nvidia shares. But this was more an exercise of, if you had, how much money would you have? Which is interesting to people, I think, and highlights quite how much they've risen by. And just to give you one of these numbers, if you had bought £10,000 of Nvidia shares 5 years ago, you would be sitting on £138,600. Those were the numbers that I worked out on Wednesday afternoon, right? That is a huge, huge gain. It's more than 13-fold, almost 14-fold, in fact. And it also takes into account the pound's climb against the dollar, which has reduced the gain for a UK investor when you translate it back into pounds, because you would have got... when you invested that money, you'd have got a certain amount of dollars for your pounds, and Nvidia shares are dollar denominated. And then you've made a load of money, but now you have to divide it by the dollars back to the pounds amount. And the division by the dollars back to the pounds amount is now bigger. So it reduces the return. You'd have actually made, I think, nearly 15-fold if it wasn't for the currency movement. The thing is, though, right, and this has come as Nvidia has ridden the tech wave, and it's gone from being renowned for a company that was really good at doing computer chips for gaming to the company that is at the forefront of the AI revolution. There's been a lot of hope, a lot of hype through that, but there's also been a lot of ups and downs. And so you would have had to have held on for that entire period. Now, if you had put £10,000 into NVIDIA 5 years ago, so you shrugged off the weirdness of COVID lockdown 1, it was a sunny May. Perhaps you were sat at home. You decided that you were going to do a bit of trading as you were WFHing or furloughed, as lots of people did. And you went, right, I'm going to stick £10,000 in NVIDIA. Ballsy. That's a big investment in one company. Wouldn't recommend doing that kind of thing unless you've got at least another £90,000 that you're going to invest in 10 other companies. So you've done that, but then you've held on all the time since. If you had done that, you would have seen the shares almost quadruple in 18 months, then more than halve in a year, and you'd still only have got to October 2022. COVID hadn't even finished yet, and you've already seen that happen. I mean, this year alone, NVIDIA's share price has fallen 35% at one point from peak to trough, and then rebounded by 44%. And you're holding on to that white knuckle ride to make your money. Okay, so I always think this when I look back at, those massive gains that you could make on stuff. I think it about Bitcoin as well. That thing where I wish I'd bought a Bitcoin the first time we wrote about Bitcoin. It was like 2013. I think you could have bought a Bitcoin for about $100 or $200, something like that. But if I'd have bought a Bitcoin at that point, would I still have the whole Bitcoin now? Or would I have cashed it in at some point? I mean, when it got to my throwaway sort of gamble on $100 worth of Bitcoin suddenly became worth $1,000 or $3,000, maybe I'd have gone, I should cash this in. When it became worth 10,000, 20,000, 50,000, 100,000, you'd be like, when am I ever going to make this much money on $100 again in my life? But even like from 100 to 2,000, you'd be like, oh yeah, I just need to sell this. I mean, I know somebody who was in this position and they sold out a long time ago in like one of the first bubbles. So if you can hold on for dear life and do this, then that's great. But actually, most people wouldn't manage to do it, right? You probably would have sold out before now. And even if you had have done it, you'd be massively overexposed to Bitcoin, NVIDIA, whatever it is that you've got that's gone up by so much. But anyway, if you had managed to hold on all of that time, you would have a huge amount of money. And just to put some figures on this, okay, if you had bought, I've told you what would have happened if you bought in 2000. If you had bought £10,000 worth of NVIDIA shares, 1999 at IPO, you would have £36 million. I mean, what are the chances of you having done that though, right? What about if you bought them in 2006? Well, you'd have £3.7 million. Not bad. 2012, you'd have £4.7 million. You'd have even more money if you bought in 2012. 2018, I mean, you'd only have £220,000. Yeah, I mean, look at that. You'd be looking at those other guys and girls thinking, I really missed a boat here. I've only made £210,000 on my £10,000 investment. And if you bought in 2022, you'd have just under £120,000. But again, and as I would say, also, NVIDIA is a really great company. It's making loads of money. For that to happen to a company, the stratospheric share price return actually just in recent years, or the things moving around this year, for that to happen to a small cap, you would expect. But for that to happen to one of the world's largest companies is really quite something. And it does illustrate the slightly weird stock market that we are in at the moment, particularly driven by those, US Magnificent Seven companies. But I have also made the mistake in the past of holding shares that have made a huge return. I have once held shares that 10 bagged. That means that they went up more than tenfold. Boohoo shares. Unfortunately, I only bought about £300 worth of them. But I also held them all the way up and then all the way back down to just above the price that I bought out when I went, oh my God, they're not going to go back up again. I'm just getting out before I don't want to lose money on this over the 5-year roller coaster period. So I sold them. I did make some money on those shares. I think I probably made about £300 in the end, but I could have made 2,700 or more kind of thing. And it sort of illustrates the mistakes you can make. And people did this. This was pre-financial crisis. There was a lot of that with bank shares. People held bank shares all the way up and all the way back down. And lots of people are still holding them, and they've never gone back up. I mean, I've got some Lloyd's shares that I bought in the rights issue on the basis that they were definitely going to 100p. They ain't been at 100p yet. But then on the flip side, the cashing in some gains, I had some Rolls-Royce shares that I bought in 2021 in that kind of point where you had these giant companies that totally crashed, and you were like, the market's almost pricing them as if they're going to go bust. They're not going to go bust. These shares are too cheap. I bought those Rolls-Royce shares at 141p. In early 2024, I cashed in at 300p. I had a stop loss basically because I didn't want to suddenly lose a load of money, and I needed the money there to pay the bills for doing our house up, right? Again, don't invest the money that you need for doing your house up. Just to be clear, this is not a clever financial strategy, but I had done that. I was willing to take that risk. And, it was great. I'd more than doubled my money. That was like a fantastic return on investment. If I still had those Rolls-Royce shares now, they'd be worth nearly 3 times as much. So I'd have made even more money, but I didn't. And that's the point. Coulda, shoulda, woulda. Be careful with that stuff when you're investing, because that's how you make mistakes.
We could talk about so many things related to this. The one thing I do want to ask you is, okay, maybe not £10,000, right? And maybe you won't, you're likely not to luck out with something like Nvidia. But do you have any tips if you are interested in investing and you are looking for those little companies right now that could be great? What are you looking for in the early days of investing for those companies? Have you got any tips?
The tips that I would give you is the things that I have learned from speaking to professional investors over the years, whose job this actually is. And that means they get to dedicate all of their time to trying to find shares that are ultimately going to outperform and beat the market. And they might be investing in some of the world's largest companies like Nvidia. So, for example, Tom Slater of Scottish Mortgage, who, I've spoken to a number of times. Or they might be trying to invest in some of the smallest companies on the stock market, like some of the small cap managers that I've spoken to. I've got an investing show coming up soon with the manager of an investment trust called Rockwood Strategic, which buys into smaller companies. Or they might be buying kind of mid-sized companies. Ian Lance of Temple Bar, I did an investing show with him recently. I'd say if you're interested in this kind of stuff and you're interested in stock picking, then look that one up. This is money.co.uk/investing show, where you can find all the investing shows and watch some of those. And just because the idea of those videos is to basically try to get a little bit of an understanding from these professional investors about what they do and how they do it. But the things that I've learned are, firstly, a lot of these picks are going to go wrong, right? You have to have a portfolio approach. You cannot just go, right, I'm sticking it all on red or black, or Nvidia or Meta or something like that. It has to be across a portfolio. Academic research shows you need to hold about 15 to 20 shares basically to get a properly diversified portfolio. But they need to be 15 to 20 shares in companies that don't all do the same thing, or share prices that all move in the same direction. So, for example, if you've got a 15 strong share portfolio and 7 of them are the Magnificent Seven, those 7 companies have a real tendency to move up and down at the same time. And in fact, David Coombs of Rathbones, another person I've done an investing show with, he said, you need to just think of the Magnificent Seven as like an asset class. You obviously need to look at the companies individually on their own merits, but you also almost need to think of it as like an asset class in itself, like gold, shares, bonds, Magnificent Seven. You need to do your research. You need to really look into it. And this is my own experience of, having held a share portfolio over the years. I thought, I could build my own share portfolio. And do you know what? Some of them have done well. Some of them have done average. Some of them have done absolutely terrible. For every time I got lucky with a Rolls Royce, and that was just a really obvious one to my mind. Rolls Royce, BP, companies like that, COVID, it was just like, these are way too cheap. The two things are happening here. They're either going bust or they're going back up. These things are just way too cheap. That was, I think, an obvious value opportunity. With other companies, things like spotting an Nvidia or something, but that's really difficult. If you talk to the guys at Scottish Mortgage, Tom Slater will say it's a portfolio approach, and they are looking for disruptive companies that are going to change the world in the next 5 to 10 years. And that means investing in lots of companies and knowing that a sizable number of them won't succeed. They might continue, they might not go bust, but they won't succeed in those dramatic ambitions. But the ones that do succeed, that success will be so great that it outweighs, the rest of the stuff. And you cannot expect that kind of investment. So, for example, if you do invest in Scottish Mortgage, you can't expect it to go up all the time. They are very open with people that they will see more volatility. You will see times when the shares fall 30%. We have seen that. Scottish Mortgage shares are up quite a lot over the last year or so. They've had a really strong rebound. They're still way below their peak. So it depends, how you're investing, but you really need to think about it. You really need to keep an eye on those companies, and you really need to not latch on to this idea that you're going to bag this massive Nvidia return or something like that, because those are so rare. It's so rare that happens. And actually, arguably, what I would say is you're better off, if you do want to actively invest rather than just using a passive fund, I would say go for a fund or an investment trust. My personal preference is investment trusts, where you've got a manager trying to actively pick those shares, but one where they're really going to add value. So, for example, going back to the smaller companies thing, one where someone's really adding value. They've got laser focus on the companies that they're investing in. They're working with those companies to try and improve the business. They're sharing their knowledge and what's worked with other companies through the years, and that's where I think it can pay off. And then you've got someone else dealing with the headache of creating a portfolio for you.
Brilliant. Thank you so much, Simon. Right. I promised we would return to mortgages, and so we shall. The era of ultra cheap fixed rate mortgages is coming to an end, leaving 500,000 more households facing paying hundreds of pounds extra every month. Back in the day, it was entirely possible to get a 5-year fix of 1.5%, and in some cases, sub 1%. Nowadays, if you don't line up a new deal and you are coming off your 5-year super cheap one, you could be in danger of falling onto your lender's SVR. The average at the moment is over 7%. That is going to be one heck of a shock to your budget. Helen, wow, the glory days, a bit of a potted mortgage history pre and post December 2021, and how much extra you could be paying now.
So going back again to the sunny summer of 2020, loads of people moving house, and a lot of those people were getting incredibly cheap mortgages. So as you said, I think the lowest it went to was something like 0.89% at the absolute lowest, which is incredible.
I'm crying.
I know, absolutely. Like, as someone who got a mortgage about 6 months ago, it makes me feel absolutely sick with jealousy. Incredibly cheap, and a lot of people did take advantage of those deals to make a move or to remortgage. That has obviously changed since then, to put it mildly. So rates started creeping up again into 2021. The real spike came after that mini budget in 2022, which obviously sent the markets haywire. I think at their highest, the average mortgage rates went up to about 6.5%. So very, very different from the sort of 1 to 2% averages that we were seeing at the lowest. They've come down a little bit since then. There was another sort of brief spike, but now averages hovering around 5%. The cheapest deals somewhere around 4%. So, it has got better. We're not in those crazy 6% days anymore. However, we are very, very far from those 1% rates. So this matters to people who wisely decided to take five-year mortgages when rates are very, very low. I actually can't believe that some people are still taking 2-year rates then. I mean, it seems insane that you would think, oh, nah, like I won't fix my 0.9% rate for 5 years. That would be silly. But there were people that did it. But yeah, the people, the sort of last of the people on those very cheap deals are now coming to the time where they need to remortgage. And, that they are going to be paying more, obviously. The important thing, though, is that instead of just sliding off those rates and not take any action, which means you'll go on to your lender's standard variable rate, what they need to do is to remortgage to the best deal they can find today. So the difference between those two things, I think the average standard variable rate is around 7%. Yep, so Bank of England figures 7.13% is the bank's average standard variable rate. So that would mean for the average borrower, paying £1,277 a month. That's the difference between if they did choose another fix, they could be paying £766. So it's really important that people getting to that point search for the best deal out there. A good idea to contact a broker, and unfortunately, you are going to be paying a lot more than you were paying before, unless you're in a lucky position where you're able to go on to a lower loan to value bracket. You might not be paying quite as much as you would otherwise, but you're going to be paying more. But make sure you're not paying more by just not taking any action, I think is the message.
Make sure you're not paying more. Just more, but not more. Excellent.
Just regular more, not super more.
Exactly. Right, reader question time. My wife and I have been trying to sell our family home for more than 6 months. We're downsizing as my mobility isn't very good anymore. Our children grew up in the house and it means a lot to us. We've had multiple viewings but no offers. My wife insists on helping show around prospective buyers and providing them with in-depth details of the history of the house, family goings-on in the place over the years, and even highlights renovation work or improvements that need doing. Do you think buyers are being put off by my wife attending viewings? Is it best to leave viewings to the estate agent and potential buyer? Oh dear, Simon Lambert from Anonymous, I hope.
Indeed, yes, from Anonymous. Look, as somebody who's looked around his fair share of flats and houses in his life and done it with estate agents, done it with the property owners, I'm trying to think whether they've ever just opened the door and let us just go wander around ourselves. I think that's happened a few times, actually. I've seen both sides of this. Now, the estate agents here are unsurprisingly suggesting this is a bad idea. Liam Gretton, owner of Liam Gretton Bespoke Estate Agent on Wirral Peninsula, says, viewings are one of the most crucial stages of a sale and you need to be strategic about them. How prospective buyers are handled can make or break the experience and in some cases determine whether they make an offer or not. It may seem like having the owner present is helpful. However, in almost every case, the best person to carry out the viewing is your estate agent. Ideally, a personal agent who knows you, has read up and learned about the property and understands your sale. Believe it or not, most viewings are booked on emotion. A buyer has seen your photos or video tour and started imagining themselves in the space. At this stage, it's about them making an emotional connection to your home. If your wife is walking them round through her memories and family milestones, she could be unintentionally breaking this connection. Second viewings are often driven by logic. And he says at this stage, that's where the owner's insight can add value. So it's not a hard no, it's just don't let her show them around first. Amy Reynolds, head of sales at Richmond estate agency Anthony Roberts, says most estate agents will agree that it's far better to let prospective buyers view your home without the owners present. Buyers need the space, both physically and mentally, to imagine themselves living there. That's very hard to do when the current owners are walking them through a lifetime of memories, even if those memories are heartwarming. Now, I would agree with what's been said there. However, I would also say that I do actually think that it is good to meet the seller and to talk to them, because you can ask them the questions that you can't ask the estate agent, and the estate agent won't know the answer to, because the estate agent, if they're really good, will have tried to work out all the questions that are going to be asked and have an answer to them. But at the end of the day, they're not going to really manage to work out all those questions. And that's if the estate agent is really good. And whilst I suspect that both of the estate agents we spoke to are really good, not all the estate agents that have shown me around properties have been really good. I don't know whether this will come as groundbreaking news to our podcast listeners, but some of them have been frankly useless. Some of them I'd have been better off being shown around by the owner's toddler. But, some of them have been really good. But the problem is they'll talk, when they're selling, as someone who's also sold properties, they'll tell you that they're going to do a really good job and show everyone around. But if you're not there, you have no idea what they're saying to people. And I suspect on some occasions, some of the ones that we have employed have sent someone around to do the viewings who's been quite useless. But what I've found in personal experience, first flat we bought, we got shown around by the owners because it had just come back onto the market. I saw it in the estate agent's window. It was a Saturday afternoon. The estate agent didn't have anyone who could show us around. We were then going to be away. They contacted the owner. The owner said, I'll show them around. We went round the flat. We really liked it. me and my wife sat down in the garden and to have a chat with the owner. He said, well, why don't we go sit in the garden and talk about it? We talked about what sort of money we might want to offer. He said, well, actually, because it had already been on the market and come back on, he said, yeah, we can't do it for that, but we could do it for this. That's the money we need in order to move. And that would basically get us back to where we were. We agreed on it. He said, I'll let the estate agent know tomorrow if you could drop them an email with the offer as well. So we dropped them an email and said, we've agreed the offer with the owner. This is how much we're buying it for. Now, we got really lucky there, because if the owner had put the flat back on the market, it was at the point when the market was going up and he could have put it on for more. But then another time, I think we got shown around by the estate agent first and then by the owner. And that did help, because you could ask them lots of questions. But we have also had the times when we've been shown around houses by slightly batty owners. And it was quite funny. And we've had some really lovely people as well. There was a really lovely lady who showed us around her house, and she had lots of cabinets with little figures in, all around the house, and a gun room.
Oh, wow. You will like this house.
That was the husband's hobby. These things weren't directly connected. She was into little figurines. He was into shooting. I don't know whether he shot the figurines. Maybe the cabinets were bulletproof glass. I don't know. My youngest daughter did say, though, she said, I really like your house. It's just like a museum.
Oh, wow.
And she said, oh, that's so sweet. I was like, oh, thank God she took that the right way.
I know. See, that's my problem. I've got zero poker face. If I see something I don't like it, I'll be like, and if you're around the owner, you don't want to be doing that. But when we went round the house that we bought, which was an interesting house, there was all sorts of, how do I put this, sexual paraphernalia just dotted around. Yeah, oh yes, it was an interesting place we looked around. And the lady, who I would be quite peeved if I was a seller, basically she said, I'm so sorry, I can't answer any of your questions. She was from the estate agent. She goes, I've just been brought in because there's no one else that was around to do this, and I've never seen this house and I have no information about it. I thought, okay, we still bought it. So there you go.
I'm sorry, I can't answer any of your questions. I don't know anything about this house, but that's not my sex toy.
Yeah, exactly. But these are not mine. Absolutely. Right, that's it. Simon, stat of the week, please. Moving swiftly on.
70. That is the age that Denmark is raising its retirement age to.
Yeah.
70 by 2040. Got people asking a question. Could it happen here? Now, the state pension age is up for review. There are questions as to whether it should go up or whether it should not. It has been going up on the basis of longevity. Longevity rises have tailed off, actually. But there's more of a potential for it to go up on the basis of cost at the moment. This potentially has quite a big impact for people, because it's not just the state pension. It's if they raise the private pension age, the age at which you can access your money, which in theory is meant to track the state pension age minus 10 years. But you could see if there was a big jump in the state pension age, that might suddenly cause a problem, because, you could be 15 years away from retirement and planning on getting at your workplace pension at a certain point. And if that suddenly jumps up by 5 years, you could have a real issue. But yeah, 70, that's my stat from Denmark. By 2040, that's when it's going to do that.
Right. That's it for this week. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Simon.
You can email us podcast@thisismoney.co.uk, and you come to thisismoney.co.uk/podcast to find all podcasts past. And you can watch those investing show interviews at thisismoney.co.uk/investing show.
Do. And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Take control of your finances with Charles Stanley Direct. Invest, save, coach, or plan. Using technology where it's helpful and people where it matters. Our website and app make trading cost-effective and flexible. But we're more than just an online investment service. We're here for you regardless of your financial needs or if your life takes an unexpected turn. Your finances, your way. Take control today with Charles Stanley Direct. Sign up now.
Investment involves risk.